What's top of mind for you this week, sir?
Good morning. Well, there are a lot of things this week. So you are mentioning the economic tension between the U.S. and China. Well, we have also some better news, if I can say, on the sanitary condition globally. So which has been the driver of the market, and but we have a number of risks actually. Yeah. So that's a lot of things.
Hong Kong down 5-6% on Friday. Would you be buying or recommending buying in about 90 minutes?
The thing about Hong Kong is you look at the last 40 years, and in terms of valuation of the equity market, you come back to almost the trough that you had in the previous recession, or at the beginning of 2016. Now the main risk that we are seeing for Hong Kong equity market is that at a time when most economies are going to experience a V-shaped recovery, although we can have some doubt on this V, there is a risk that we have still another quarter of recession in Hong Kong, because actually when we look at what happened on Hong Kong economy and Hong Kong market, we have some very sharp slowdowns from the second half of 2019. So there has been the trade war, there had been some social unrest, and then you have the COVID. So I would say that you have a quite low valuation, but you also have some risk mounting on the market.
Frank, you're keen on China infrastructure stocks. Are you doubling down on that trade now, with China abandoning the GDP target and pretty much free to spend as much as it likes to rebuild and recover?
Yes. So we have the GDP target, which is abandoned, and it was something that was rather expected. It doesn't mean that the GDP expectation, there is no GDP expectation, and they are. And the highlight that we had on infrastructure stocks is remaining on. And actually, you really have two legs that you should consider. The one is on the so-called new digital infrastructure, coming to 5G, to Internet of Things, to EV charger, and so on. And you have the more traditional infrastructure in materials, in energy, in industrials, on which we are looking at the stocks with some stronger balance sheet, and which are much more domestic than international. And we think that there are still some opportunities there.
And in fact, inflation you see as a risk. Tell me more about that.
Yeah, so what it's very, very complex to try to find what are going to be the long-term impact of the COVID-19. But one of these is going to be some shrinking supply, shrinking trade, and some reorganization of the global value chain. And you have here some risks that at some stage inflation can come back, especially when you combine this element on the supply side with some very aggressive fiscal policy all over the world. So when we look in terms of our asset allocation, we like to have some inflation-related asset included in it.
Frank, one of the themes that you've flagged that I would imagine you like, Japan dividends as well. The thing is, a lot of companies right now are still cautious with how they use their cash, whether that's CapEx, giving it back to shareholders as well. I guess my question when it comes to that theme is, can I actually trust these dividend yields that I see are published right now, that I'll actually get those dividends?
There will be some cut in dividend. So when you want to look at the dividend yield, you need to factor in the fact that the dividends are not going to be as high as we see on the trailing yield. But having said that, this is the Japan dividend is indeed one of the themes that we have highlighted in the last weeks, because what we see is that the Japanese company have been holding cash for quite some time, and I think this is also one of the reasons why the valuation of some Japanese company have been lower than the rest of the market. But when we come in this situation where cash is becoming key, this is where the dividend look relatively more comfortable and more robust that we would see in the US or in Europe, especially as you can see in these two parts of the world some changing in the regulation or even in the legal framework. So I continue to believe that Japan is going to be, I would say, a safer haven for dividend.
I like how you describe it, safer haven. Okay, since you mentioned valuations a lot, I want to get your thoughts on what you actually use right now to measure valuation, because a lot of companies in this previous earnings season did not give us any guidance as well. How do you validate price to earnings at this point?
Yes, so you have two issues. The first one is what kind of earnings you are going to input, and as you said, well, guidance is very unclear. So in that case, you tend to look at some longer valuation ratio and take the 10-year earnings instead of the earnings for the year, and it can give you some indication of where we are on the longer term. So it is especially relevant in the case of markets where you can have a very long history, like Japan or like Hong Kong. And then you have another issue, which is the issue of the debt. And when you have a lot of debt, looking only at the price to earnings is not the most interesting metrics. We should consider instead to look at the whole balance sheet and to look at the enterprise value to EBITDA. And in that case, you would have some markets. For instance, I'm thinking about the European market. That my colleagues in Europe are more cautious, which on these metrics are not going to be that attractive.